Now, move aside inflation, the next wave will be the US unemployment. Now, guys, as you know from now, I have been predicting the market way in advance, just like I foresaw gold will be going up instead when everyone was calling for sell at 1,007. I mentioned that gold hit 2868, and now we are marching towards it. The last time I talked about inflation, it really happened. And again, I was spot on. Now, the thing is this right now, move away inflation because US unemployment will be next. And I'll tell you more in details. And of course, we would like to congratulate to this AIMS for getting themselves to become the online trading partner with Tottenham Hotspur. Congratulations to them. This is something big for AIMS. It's a great milestone once again. And we really, really I'm very happy for this partnership because we are also associated with AIMS as a one partner. Because AIMS now is a prime broker approved and regulated by many this exchange, and there's one of them is FCA. All right, moving along. So the thing is this right now, I understand that now everyone is buoyant with the bullishness of the stock market. As a matter of fact, right now, you can see that more than 50% of the people, investors are very optimistic of the market right now. And less than 30% of them are actually pessimistic. Now, you look at the historical view itself, usually the average is about 37.5. So we are way above. And the bearishness itself, usually about 31%. Now we're 26.4. Now, this is a very good indicator because I have been covering this for many times. And every time when we see this number, 50% or more, usually there will be some profit taking coming on very soon. And of course, if you look at what's happened when the Federal Reserve cut interest rate more than 5 times, okay, over the last 30, 50 years, you can see that there's impact of upside and downside. Sometimes the stock market will react positively, okay? Sometimes the market will react negatively. So you can see across the board here itself, right? We don't know what will happen, but it seems that there is a higher chance for the market to be down than up. Because first of all, we know that many people are taking profit from the market, including Warren Buffett himself. So all this information tells me that I need to be very careful. But of course, as we all know from JP Morgan, he says that in the last 40 years, the Federal Reserve had cut 12 times, and that is when S&P is within 1% of all-time high. As a result, the market was higher 12 out of 12 times 1 year later. So it is possible that the market will go down first. Yes, go down first, rebound, and go to new time high again. Now, this is something that I stressed over the last few videos. I said that again, very high chance we could see a pullback first and then a new high. So all this is very possible. And that's the reason why I want you to take note on this video. Now, where is the first line for support? Now, look at this S&P chart across since 2018 to now. You can see very clearly that most of the time when the S&P is kind of high and is like from between the high to the moving average, okay, which is the WMA50, every time it's about 8 to 9%, it will pull back to the moving average. Can you see that? So every time when it's about 7 to 9%, it will pull back to the moving average. So it happened many times before, and now where are we? We are now about 7.1%. So there could be another bit of upside, a little bit more, before the market pulls back. So if the market do go up a little bit more and then it pulls back, that is about a possible 8% pullback from the high. Now, based on the current RSI reading now, we are definitely in the bull market. It's very clear. Hence, therefore, a pullback of 8% would be a good place for you to buy back your position again and go back long again in the market. So I repeat myself, if the market pulls back, okay, once it hit the moving average here, you can consider to buy back your position. Now, you can see what happened recently. This is a weekly chart. A couple of weeks ago, it really happened. The market touches the moving average and rebounded from there. So I believe that this would happen again, especially we are like 3 months away from the US presidential election, right? So think about it, yeah? Now, let's go into more details. The thing is this, many people are asking, how can you tell me it's actually going to be a recession where everybody knows that the Fed just cut rates? Now, guys, you must understand what is happening right now. The credit card interest rate is now at a very high price of 21% in US. Now, this is crazy price because 21%, guys, imagine you didn't pay this interest. And at the same time, right, you can see right now the mortgage rate is going up. The AAA yield bond is going up. So the thing is this is not a good sign at all. All right, guys, this is not a good sign. So in fact itself, right, we have to take note of it. Okay, apology on this. You not take note of the back end itself is the stock market. Okay, So now the thing is this, we have to look into more details, and you look at it right now, every time when these are surging, that means that interest rate is going up, and then credit card interest rates up, AAA bonds are up. Now all these things up, you notice that when they do in such a manner, the market is very near to a possible recession. And this is the reason why I'm sharing with you guys, this is not going to be truthful. You should be very, very careful of that. So if you look into the unemployment rate right now, you can see very clearly that when the uptick has happened, you can see that it just coincide with an incident. Now, that is, for example, in 2008, we have the financial crisis where Lehman Brothers lead it on. And then after that, we have the same thing whereby the thing uptick and COVID came in. So let me ask a question. Now, COVID time, you have unemployment going up, I can understand. Then a lot of money pumped in the market, in the system to bring the unemployment down, I can also understand. Then what is happening right now? Why is the unemployment rate going up? That is something interesting, right? We are having a good market. Or is it because there's an oversupply of jobs back then, and now we start to see this happening? Well, all I can tell you guys that this is the US dot plot that we saw in June, and majority of the federal officials, okay, all were looking at minimum 5% interest rate for 2024. But now, as we all know, the latest dot plot shows that, right, majority of them is looking at 4.5 or even 4%, all right, in the next few months. So this has changed totally, but this is just June. So what happened between June till now? Why the market has shifted goalposts such dramatically? So to me, this is going to be important because like what Milton Friedman said before, monetary policy has long and variable legs. And I believe that this legs is already on the table of the Federal Reserve Board, but then just been quiet. Because Federal Reserve Jerome Powell has said it before, it seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in the labor market condition. So that means that somehow I believe that they know what's happening right here, and that is the reason why they're cutting interest rate. So the thing is this, if you look into deeper, you can see right now in the past, right, all the past inflation, all the past unemployment, let's say in 2020, you can see that it was 3.6%. And then after it moved down again, you see it was 4.7%. That was back in 2009. And of course, you look back further down, you can see that it happened again in 2001, 4.2%. And of course, all the way to 1969, 3.5. And where are we now? 4.2. So with all this information coming in, when I put it all together and I put it between the Dow Jones and the unemployment rate and the SAM rule, you can see that this thing is the same. Now, you can put on SAM rule or some rule is the same thing, but you can see right now we have a very clear movement here. And when that happened, you can see in the past, the stock market pulls back. See that again? The stock market pulls back. So that is the reason why I feel that we need to be very, very careful and moving forward. I understand that many people are still very bullish on the market. I'm just informing you just to go slow. Now, I'm not calling for a crash. I'm looking for an 8% drop from the highest point. So if that really do happen, then that is a good time for you to buy in the market. Now, Jeff Gundlach, right, he's the bond king, known to be the bond king, has already mentioned that the US economy is already in recession. He feels that the Fed rate cut is very late. And the thing is this is going to pull the market. So you look at the 2-year Treasury spread, and we all know that the US Treasury use a lot of 2-year spread as a form of indication for their interest rate. And so where are we right now? The spread shows that we are now near to the low, and that was where the Lehman Brothers is. But the difference is, back then when they're doing this, the Lehman Brothers are already start to have it's shaking and stuff like that. So the question is that then where's the shaking now? So this is the reason why a lot of people is asking the same question. But if you look carefully what happened back in Lehman Brothers time, you can see right now it's showing the same curve. So which means that, right, it's a matter of time. This is the reason why the Fed had to cut rates so urgently, because they know that they are moving away from the curve quite a fair bit. So with all this information, what can you do to profit from the market? Now, guys, I have been very, very outspoken on my belief in gold. I believe that gold will go higher. Watch my video, the past video, and I said that gold will go up to this 2570. That was 1 month ago, and gosh, it hit 2570. Now at 2620, guys. Isn't that accurate enough for you? So the thing is this. Now you look at it, what happened in 2006 and 7 versus today's market. Look at it, the way the gold is moving, it's identical. But don't forget, back then, excuse me, you can see that. Oh, let me bring the chart again. Okay, just bring the chart in again. Okay. Oops, sorry. If you look at the chart, oh gosh, give me a minute. Okay, if you look at the chart once again, guys, you will see something very, very important. Let me just pull back one more chart for you. Okay, if you notice this, the chart looks very identical, but one crazy part is that this has happened during the recession period. So which means that we haven't seen the recession yet. And if the recession period come, that is the reason and the catalyst to bring gold price to 2868. All right, that's something that you must remember. I'm the first person who called this number, and I believe it will relatively happen. So to wrap it up itself, guys, take a look at my prediction. Now, this is what happened on the US dollar. It has fallen from the 105 level at the level I mentioned back in a few months ago, and now it's trading at below 100 level, near the 100 level. And I said that when that happened, the gold price will hit 2540, and now we are at 2621. So now the thing is this: if the dollar could continue to go down, I suspect go to 96, then we'll see gold going up to 2868, guys. This is something can happen by March 2025 or even earlier. So with all this information, think about it. What will happen in the market? Make some money from our market, contact us. And this is Cal signing off. Take care and have a great day. Bye-bye.